For the first time in nearly 3 weeks, the S&P 500 has closed with green on the BX trender. This has been my exit requirement to close my puts and my hedge against my main portfolio. In this video, we're going to go over why I put the hedge in place in the first place, why I picked the specific strike that I did and the specific day, why I waited until now to finally close out that position, and more importantly, if I regret the decision. Before we get into the analysis, if you want to get access to all the indicators that you see me use here each and every single day, learn our exact system to get in and out of positions completely for free, no credit card, no BS, no fluff, not emailing you 100 times, the link to our 12-course masterclass series is in the description. The only thing that I ask in return for giving you my entire system for free is just to take the courses in sequential order. It's not enough for you to just understand the indicators and why we are doing what we're doing. There's a lot more that comes to professional trading, such as risk management and position sizing, because you can see here that over the past coming up on 3 years, we only have a 61% win rate. So knowing how to lose, knowing how to properly position your fund and trading portfolio is just as important, if not more important, than the mechanics of trading. Now, the reason that I put this hedge in place is for a couple of reasons. Number one, if we zoom out to the monthly chart, you can see the BX trender, which is this oscillator indicator at the bottom of your screen, has flipped red as of March 2025. I have highlighted in blue all of the times over the past decade that the BX trender has flipped red. And you can see that each one of these times was not an ideal environment to be trading the S&P 500 long. Now, it's very rare that I short, right? I very rarely just open short a position or get puts. It's only during like these times where we have like 96% of our fund long that I will start to open some protective shorts or puts, which I've done. Most of the time, and this is to answer the question I get a lot as to why I don't short, the reason is that these pullbacks last most of the time half the length that these expansions go. And so we're always going to lose when the trend shifts. So I want to focus instead on these long expansions because we're always going to lose and catch a top, as opposed to trying to short and getting basically killed on the way in and the way out, and then maybe getting a couple of good setups for a couple of months. The juice normally just isn't worth the squeeze. Now, in the case of the S&P 500, we were bullish when it was pulling back to $485 because if you look at the monthly BX trender, yes, it's red. But if we look at the the market bias, which is this band indicator here, which we also teach down in the description, it is very, very rare that we actually break and hold below the market bias. Like the only time that this has really happened for a sustained period was the 2008 financial crisis and the 2000 dot-com bubble. And that's why when price was trading between $480 to about $500, we were buying the living crap out of the dip down here up to about here. But since then, the S&P 500 has made a full V-shaped recovery, bounced 23% in about 2 months, and we decided to open up a short position against the market because we have all of these profits that we made buying the dip. And I don't want to realize all the profits that we have right now, right? We want to continue to, hopefully, if the market continues to run, to continue to make more off of that. But what I want to do is protect myself somewhat to the downside because the risk versus reward at this point is simply not there anymore. It's not as lucrative going long now as it was back between 480 to 500. The other reason that I wanted to go short or put a hedge in place is because structure was still bearish. If you've taken our Smart Money Mastery course, you know that once we break a previous support, such as this level of $576, and price action is no longer making higher highs and higher lows, this is called a break of structure. And in most cases, what will happen is price will sell off, bounce, not take out the previous high, and continue to sell off in this manner. So my thought was that if this were to occur, I want to have some sort of put in place to protect my downside. Now, when structure is bearish, what we will do is take our Fibonacci retracements, We go over the exact settings in that course. We will go from recent highs, which would be February 19th, 2025 at $613, down to most recent lows of $489. If we pull the Fibonacci out, the main area that we are looking at is going to be the 0.826 from $592 to the 0.786. This area here is going to be called the smart money zone. This will normally be in bearish structure after a significant bounce, the highest that institutions will allow the stock to bounce to before selling off and filling the downside gaps. So if this happened, once again, we want to make sure we have some sort of protection in place. The other reason that we were bearish is because of this volume profile on the right side of your screen. This is going to show us how many shares were traded since October of 2024. You can see the bulk of the shares were traded between $610 to $580. That's why we have this wide area on the volume profile. This area will tend to act as a resistance, giving us another piece of information that price could be rejecting soon. This red line right here is called the point of control. This, once again, is the highest area of volume since October of 2024, which will also act as a major resistance. So we have a lot of bearish information. We have a smart money zone drawn out by the Fibonacci's, acting as a resistance. We have the volume profile acting as a resistance. We have the point of control acting as a resistance. We have the monthly BX trender showing red. And at the time, we also had, up until today, the daily BX trender showing red. These are all signs of a potential rejection. Now, does this mean that it has to happen? Of course not. As you know, we only have a 61% win rate historically, but I will stick to my strategy over anything because I know long term that it will more than profit what we need. And I know that long term, sticking to my strategy is something that I can do realistically, as opposed to trying to time the tops and time the bottoms to absolute perfection, which you might be able to do a couple of times per year, but you won't be able to do it each and every single day. So do I regret putting my hedge in place? Of course not. Tomorrow, as long as this green BX holds, I will close out my trade, most likely for a $25,000 to $30,000 loss. But if this expansion to the upside continues, then I should pretty easily close out an $80,000 to $100,000 profit on the rest of my positions. And so at the end of the day for me, as long as I stick to my system, that's all that matters. That's what I consider me being a winner or a loser for. Not what I made today or tomorrow, but did I stick to my system? As always, guys, thank you for all the support. If you want to learn our strategy completely for free, the link to our 12 series masterclass is down in the description, completely for free. If you want to trade alongside me each and every single day, get access to all of my real-time trade alerts and all of our trading bots. The link to our Discord community will be at the very bottom of that masterclass series. Thank you for all the support. I hope you have a great day, and I'll see you tomorrow.